the CBN directive to the banks for them to divest from all non-banking subsidiaries. I mean, what's the impact of this revoking of universal banking laws?
No, I think the first thing is that they either divest or they constitute themselves into a bank holding company. So I think a few of them have decided to go via the way of a bank holding company, while a few have actually decided to divest. So the impact is that there will not be basically the segregation of services as against an aggregation of services. And it will make them theoretically focus more on their core business and use less of the balance sheet and depositors' money to engage in proprietary trading.
Right. Let's talk about the various options available to the banks. We're told that, as you're suggesting, some are seeking commercial, others are seeking international, others are seeking regional licenses. What does that mean?
Basically, it means that you focus on a particular area. If you have a capital of a particular over 50 billion naira, no, over 100 billion naira, then you can be in the international space. If you have capital of 50 billion naira, you can be a national bank. And if you have just 25 billion naira, you can be a local bank.
All right. Now, initially, a lot of industry players were looking for clarity as to what the change in universal banking laws is going to mean for their group holding structures. Now, you've alluded to some of the options available to them, but effectively, what sort of changes are we likely to see in terms of the structure of financial institutions and shareholding and the group holding structure and management?
First and foremost, from a strategic perspective, once you increase the number of players and you lower the barriers to entry, basically you make the industry more competitive and fundamentally probably more unattractive for existing players. And in the long run, it means that people, those where the margins are compressed and are unable to cover their costs will exit the industry, and those who remain will be competitive. Now, what it does mean is that those that are playing the scale economies game, who are playing with size and use their balance sheet and have a national spread and reach, will be able to do that, and with the scale economies reduce the average cost of doing business. While the niche players who look at particular areas or particular product areas or particular geographies will focus on those areas. And ostensibly, because of their specialization, are able to charge a return that covers their specialized costs. I think that is what you're going to have. But at the end of the day, I think that there will be segmentation. There will be the banks that are in the lower segment, and there will be banks that will be in the mid segment and then the upper segment. And they will complement one another, in fact, some serving as correspondent banks in favor of the others. Now, what is the impact of a divestment in terms of, if you're talking about 190 billion, which is about 1.2 or so billion dollars in a market of this size? Not that significant. It only means that the guys who are going to buy these assets will have to now either rationalize them, depending on at what price they bought them, and focus their attention on particular core areas of the market and probably extract greater value because of their specialized nature and the fact that they are now owned separately from the integrated model of a big bank. The jury is out as to whether the integrated model of banks or the specialized model is the most efficient.
Some experts are raising concerns already, Bismarck, that this is going to create an asset overhang, is the terminology that they're using, and they're very concerned about who's going to be standing by to buy up some of the divested assets.
Yes, it is true. Obviously, there's investor fatigue in the market right now. We need some kind of catalyst to start buying, even from the asset managers and all of that. To put assets into the market at a time when there's a overhang like this could actually create more problems in the short run. But I think that in the kind of private treaties that are going to take place between the sellers, the vendors on one hand, and the buyers, they will allow for staggered payment terms and all of that, or they'll bring down the prices. But I do not see how this will actually help to depress the prices in the stock market already, because the stock market has already factored in this divestment in the present valuations.
Obviously, there's been a lot of focus, Bismarck, on the so-called rescued banks, and obviously at the moment we're watching merger talks with regards to who are some of the players who will be buying up the rescued banks. In what way would this process be impacted on by changes on universal banking laws?
Well, I think the entire rescued bank problem and the way it's being gone about, it's quite interesting, and I think in the end we are going to see the Nigerian banking system come off better off for it. However, there are some critical issues about interests that have to be taken care of, and basically there can be no conflict. There should be no conflict of interest. There's no reason why the banks, whoever the bidders, would have to have any kind of private treaty with the existing interim managers, because that would be an abuse of the process. The central bank must be seen to be an independent and impartial facilitator of this process. There can be no undue advantage given to one bank over the other, so it has to be as transparent as possible. However, whoever is going to buy, the people that are bidding for these banks have already factored in the actual cannibalization of some of the banks where the integrated model didn't work. So whoever is bidding for the banks is going to buy the core business, rationalize the people, rationalize the branches, and rationalize some of the businesses. So I don't think this process will have anything to do with the valuations. Those valuations were pretty conservative in what I heard about.